So in this video, we want to continue our discussion of money and think about what role banks play in the economy and how they create money. So I think that this lesson is important for you to understand so that you can incorporate your understanding of the health of the banking sector and your predictions of economic activity. So if your job or if your financial health depends in part on forecasts of what the economy will look like in the future, then you can use part of your reading of what is happening to the banking sector of the economy to inform what you think will happen to the economy more generally speaking in the future. Also, I want you to be more familiar with some of the examples of how banks can act to improve living standards, and we're going to look at some recent 2020 newspaper clippings or titles to provide some examples about how they do that. And I want you to be aware of the role that banks play in the economy as well as how they create money, kind of the whole title of this video. So if you remember from our discussion of financial capital markets and of introducing financial capital markets into the circular flow diagram, which we looked at the beginning of class, banks act as intermediaries which lower the transaction costs of capital exchanges. And so instead of borrowers taking loans directly from savers or paying loans directly to their creditors, we're going to think that savers put deposits in banks and take withdrawals from banks, whereas borrowers take out loans from the banks and repay their loans to the banks. And the banks act as intermediaries which lower friction between borrowers and savers so that a borrower doesn't have to find a saver, doesn't have to find an investor every time they're looking for money. They can just go to the bank, and the bank should have a long list of savers which are willing to part with capital for the borrowers to use for their consumption needs or their business investment needs. So there are related institutions such as credit unions or savings and loans, which act as other financial intermediaries for capital exchanges. But for this video and in this class, we're pretty much just going to use them all synonymously under the title of banks. So we track the balance sheets of banks using T accounts. And so T accounts are going to keep track of bank capital or net worth and are going to balance how much is owed to the bank versus how much the bank owes. So we're going to focus on three different components of these T accounts. We're going to focus on liabilities, on assets, and on net worth. And so the liabilities are going to be deposits. So that sounds odd, right? Why typically we think of liability as a debt or something that puts your financial health at risk, something that you owe to somebody else. So why is a deposit in a bank considered a liability for the bank? Well, that's because due to regulations in place, we know that that bank is going to have to repay the vast majority of those deposits to their to the people or to the companies which deposited those funds in the bank should they request those funds out of the bank. So if you go up to the bank and say, look, I want all $50,000 out of some bank with, I don't know, what's a good bank to use, Fifth Third or something, and say, I want all $50,000 I have in my checking account now, they have to be able to pay you that $50,000 and give that to you in some form. So that is money that the banks owe to others. However, they can take those deposits and use them as loans for other banks or loans for companies or individuals. So that's money that's owed to the bank from other banks or from individuals or companies. They can buy assets from the government, such as treasury accounts or governmental securities, and they keep some of it on hand as reserves. And so all of these are positive for the bank. These are all assets. And then we subtract from the total of these assets, being 11 million, the value of the liabilities, 10 million, and we get 1 million in terms of the net worth for the bank. So that is, they have a positive balance of $1 million. Their net worth is 1 million. So let's break down or go into a little bit more detail, investigating what some of these assets, common assets and liabilities are. So loans are probably the most intuitive here. We're familiar with what a concept of loaning someone money is. However, we want to think of two different types of loans in this market. Think of the primary loan market. So this is the market for loans from like households and companies. And the secondary loan market is when a loan which one bank has made to a household or a company is then sold to another bank. And so when I bought my first home back in Ohio, we got a loan, we got a mortgage from a small local bank. And immediately after we signed that mortgage, they sold it to a much larger bank and just collected the profit from that sale and didn't have the continued liability on their hand, or didn't have, didn't have the possibility, the exposure to us not making good on our payments, or having to wait 30 years for those payments to come in. And so that loan was then sold on a secondary loan market. And so the price at which those loans are sold on the secondary loan market are determined in part by risk of default. So hopefully they didn't think that I was going to default on my mortgage, and so that would cause a higher price that they could have got for selling my loan, and in part by the interest rates at which the loan was made. So those are going to determine the price for loans on the secondary market. We can also look at how the federal funds target rate has changed over the past 12, 15 years. And so this is going to be the rate at which the banks borrow and lend their excess reserves to each other overnight. And so generally, you think of this as being the interest rate banks pay for borrowing from other banks, which is then going to work its way through the banking system to eventually make its way to consumers, and impacts the rates at which we can get mortgages or auto loans or home equity loans, how we can borrow, the price we pay to have money now versus in the future. And so we can see that following the Great Recession in 2008, this rate stayed near zero. And then starting in 2016, it started to climb. And then following the coronavirus and the impact that looked like it was going to have on the economy, we immediately slashed that rate back down to near zero, and have discussed the possibility of actually having negative interest rates in the US like they do, and they've experimented with in some Scandinavian countries. So one of the other key assets in the T accounts for the banks are bonds. And we saw these as USGS or government securities in the T count example we looked at. So bonds are going to be fixed rate investments for a defined period of time, typically issued as a way of borrowing money. And so a bank may take some of its deposits and use them to buy bonds. And so they would then say, we're going to part with $5 million for 10 years, but in 10 years, hopefully, not hopefully, we're guaranteed, because it's a fixed rate investment, we're guaranteed to have, let's say, $6 million. And so it's a safe way of investing, a safe way of increasing their net worth, but at the same point in time, it is going to be predetermined. It's going to be less susceptible to market forces, and can also is a way of drawing liquidity out of the system, drawing money that could otherwise go to loans out of the system. And so we'll look at this more in the next video, but when the Federal Reserve Bank, when the government's bank, buys bonds from local banks, then or from companies or from local governments, what they are doing is giving them, they're paying for the bonds, they're giving them liquid assets they can then use to either make good on their payments if they're a company or a local government, or to create more loans if they are a bank. And so following the coronavirus and the recession that was accompanying the coronavirus, or the economic calamity in early 2020, we saw the Federal Reserve Bank not only buy federal government bonds, but buy municipal debt. So meaning like local governments for the first time. And this was obviously good for local governments, but at the same time was illustrative of how dangerous the Federal Reserve thought the pandemic would be to the economy. And so, once again, we can see Federal Reserve buying bond markets. We saw Federal Reserve buying corporate bonds, and really all of these were a way to inject more liquidity into the system and essentially increase the money supply. But we'll look at that more in the next video. Now, the last form of asset that we're going to consider is that of reserves. And reserves are just financial capital that isn't being invested and isn't earning interest. So it's not a loan and it's not a bond. It is just money that they're required to keep on hand to be able to make good on depositor demands of money, or to hopefully stem off a bank run. And so once again, in the spring of 2020, this is just one example, South Sudan cut interest rates and the reserve ratio to buffer the economy. So this meant that the banks would no longer need to keep, let's say, 10% of all of their financial capital in the form of just cash on hand, which can't be invested, but maybe they'd only have to keep 5%, so that extra 5% they could then lend out to companies or households as additional loans, so that they could stave off some of the financial perils of the coronavirus and the economic calamity that ensued. So the last concept that I want to discuss in this video is that of the money multiplier in banking. And here we're going to see kind of a similarity with the Keynesian multiplier. That, remember, the motivation behind the Keynesian multiplier and the Keynesian cross model was that one person's spending becomes another person's income. Well, for the money multiplier in banking, we're going to think that one bank's loan is another bank's deposit. And so in this case, we can see that with the $10 million deposit in bank A, if there's a reserve ratio of 10%, so remember, to meet the possibility of a bank run, they need to keep 10% of their financial capital on hand in the form of reserves, then 1 million of that 10 million is going to be held in reserves. 9 million is going to be able to be distributed in the form of a loan. So let's say they create a loan for Hank's Auto Supply. Well, then Hank's Auto Supply then will take that $9 million loan, and they're not going to just keep it in a mattress or keep it in their warehouse, because if the warehouse burns down, then their $9 million is going to go up in flames. So they're going to deposit that loan in Bank B, and that becomes the deposits in Bank B, of which 10%, 900,000, is going to be held as reserve, and then 8.1 million can be a new loan, and that new loan will then be deposited possibly in another bank, or possibly back in Bank A, which can then use it as a way to issue even more loans. And so fortunately, we can actually recognize a numerical pattern in the money multiplier and come up with an equation to be able to predict the increase in the money supply, which will result from just an exogenous or autonomous increase in deposits, or increase in exogenous increase in assets. For example, if the government buys bonds and frees up financial capital for a bank to make more loans with. So this equation is very simple. It's just the multiplier is going to be 1 over the reserve requirement. And so we're just going to multiply that multiplier by the excess requirement. So by whatever external source of financial capital we now have that we do not need to hold in the forms of reserves. And so if we want to know how much this $10 million deposit is going to increase the money supply, then we're going to multiply 1 over the reserve requirement, which we saw here is 10%. So 10% of it needs to be held in the form of reserves, by that initial amount of excess reserves, that $9 million. And so when we do that, we see that the total change in the M1 money supply is going to be $90 million. So by having that initial $9 million in assets, which was due to the $10 million deposit, that is going to, when rippling throughout the rest of the economy, when being deposited in other banks, creating other loans, is going to create a total of $90 million in additional money. So now that we see how banks can essentially create money by turning one person's deposit into another person's loan, in the next video, we're going to look at how the Federal Reserve, or I guess in the next video, I'm going to introduce you to the Federal Reserve. And in the following video, we're going to look at how the Federal Reserve can use different policies at their disposal to help banks create more money.